Okay, let's start. Hello, everyone. My name is Roy Culpepper. I chair the group of 78. And I'd like to welcome everyone to this webinar on finance, climate risk, and how to make your pension fund climate friendly, the second of two webinars. The first was held last week on November the 24th. If you missed it, you can view the recording on the Group of 78 website under the podcast YouTube tab. This webinar is co-hosted by the Group of 78 and Climate Legacy in partnership with Shift and the Unitarian Church. Once again, our guest speaker is Adam Scott from Shift, and our moderator is Ricky Stewart from Climate Legacy. But first, I'd like to acknowledge that the city of Ottawa, the place from which I'm making these introductory remarks, is in the traditional unceded territory of the Algonquin Anishinaabe people. As we discuss how to combat the climate crisis, we must recognize that Indigenous communities have for many generations cared for the rivers, coasts, forests, the land, and the life sustained by nature's bounty. We must learn from their example and respect this legacy. On to our discussion. In the last webinar, Adam talked about how our financial investment decisions typically have a much larger carbon footprint than decisions by consumers, for example, when they buy gasoline-powered cars. So, what can we do as individuals managing our savings, as members of pension plans, or simply as consumers, citizens, and taxpayers to affect financial investment decisions in order to make them climate friendly? These are the questions Adam and his colleague Patrick DeRoshi will address in their talk today. Now, let me briefly reintroduce our moderator for today's webinar. Ricky Stewart currently lives in Ottawa, but is in transit to Victoria, BC, and she works part-time as a consultant on organizational change and gender equality with UN organizations, governments, and NGOs. Ricky was Executive Director of Oxfam Canada and was Deputy Director of the Canadian Council for International Cooperation. She has taught at St. Francis Xavier University's Coady Institute. She has been a volunteer teacher, consultant, and board member, and is currently affiliated with Gender at Work and with the Climate Legacy Project. Ricky, over to you.
Thanks, Roy. It gives me great pleasure to welcome you to this second webinar. And I just want to say a very brief word about Climate Legacy. Almost 2 years ago, a small group of Ottawa-based seniors decided that they really weren't feeling that they were doing enough about climate change, and got together to think about what more we could be doing. And one of the gaps we found was linking up groups that are already active at a local level or sometimes at a national level to learn from each other and to be more effective. And we decided that we would try to strengthen that kind of networking among organizations and encourage those organizations to pay attention to what seniors can bring to their efforts. We're going to be launching a website soon, and this webinar is one of the first events that we're co-sponsoring because we've had a great deal of interest from people that we've talked to, and we've talked to a lot of both individuals and organizations. A lot of interest in this area of finances and investments. So it gives me great pleasure to introduce our lead speaker today, who's Adam Scott, who is the Director of Shift Action for Pension, Wealth, and Planet Health. Adam has been a career-long analyst of how money is used to strengthen climate action or not, and how to make financial investments more climate friendly. He's worked in the UK as well as in Canada, and is a leader in this area. His colleague is Patrick Desrochers, who is the pension engagement manager at Shift Action, and he'll be taking part also in the presentation with Adam. So we will have about half an hour for the presentation, and then there'll be an opportunity for questions. If you want to ask a question, please go to the Q&A tab at the bottom of your screen and type in your question. You can also give higher priority to the questions that have already been asked, and if you do so, those questions will move up on the list, and I'll be moderating that list during the discussion. The guidance for the questions is keep them brief, please. And last week this worked tremendously well, so I'm hoping that it'll be the same this week. So without further ado, over to you, Adam.
Great, thanks very much, and thanks again for having us come to talk about this critical and important issue. So myself and Patrick are going to present to you today, and we're going to do some deep dives into some details today. So last week, we really focused on the why shifting finance is critical action to address the climate crisis. And today we're going to build on that, and we're going to spend all of our time exploring sort of how individuals can take action to shift investments made on their behalf away from the causes of climate change, like fossil fuels, and into climate solutions like clean energy, which is critical to solving the climate crisis. So our goal today is to get more detail on what that looks like, and to give you some baseline knowledge that you'll need, and to point you in the direction of some tools to get you started taking action. So hopefully we're able to do that. I'm going to talk for a little while here about some pieces, and we're going to talk about personal. Well, I'll move into this, sharing my screen, because that needs to happen. Great. So here's what our talk's going to look like today. Quickly, we're going to very briefly recap what we talked about last week. We're going to spend some time just touching on strategies for shifting your own personal investments, if you have some. And then we're going to spend quite a bit of time talking about what Shift is really specialist at, is strategies for engaging with pension funds to help them shift their investments and to manage climate risk better. So yeah, feel free to type questions. We're going to talk about a lot of content, so if there's anything you want some clarification on or we don't address, please just ask a question. And then finally, we'll talk about specific tools for engaging on your pension fund. So to start off, let's quickly recap what we talked about last week. We spent a little bit of time just talking about the context for the conversation and the understanding the climate crisis and solutions. Sorry, I'm just adjusting my screen so I can see all my notes. And then we dove right into some in-depth content on the many types of risk that climate change poses for finance. So for individual investments of all types, for companies, for the broader economy, climate change poses an existential risk. And really the key takeaway from that was to understand that climate change represents a massive risk, and everything has flipped. So we're now in a position where not taking action to shift investments actually exposes your investments to higher levels of risk. And the solutions to climate change are actually now expected to grow faster and be more profitable than fossil fuels are in the future. And so it's not a case where we're asking anybody to leave money on the table to take this action. And that's quite significant. And it's really relevant when we get talking to pension fund managers, because they have what's called a fiduciary responsibility to invest in your best interest. And what we've clearly articulated is that it's in your best financial interest, as well as your own personal interest and our collective interest, to make the changes we're talking about and shifting investments out of the causes of the climate crisis and into the solutions. We talked a little bit about the opportunities in front of us for climate solutions. So making investments and shifting capital into these areas is exciting, and there's huge growth opportunity in those places. And we talked about sort of the path forward more generally for the financial sector. So let's move forward. So just a quick recap as well from that. This slide I thought was particularly relevant, just to recap what we talked about, which is very neatly shows you that the world has really changed just in the last couple of years when it comes to finance. So these are some of the world's largest fossil fuel companies and some of the world's largest clean energy companies. And we're now seeing the clean energy companies exceed the market value. So this isn't just potential market. This isn't just sort of in the future. This is today the actual value of companies. We're seeing a pretty major decline, especially since COVID, but well before that as well, in the value of fossil fuel companies. And we're seeing a dramatic increase in the value of clean energy companies. So this is sort of what we're focused on. And as I mentioned last week, this slide is a really important piece of context. Capital that you invest yourself, or if the capital you have invested on your behalf, such as in a pension fund, plays a critical role in addressing the climate crisis. And one of the most important actions an individual can take is to change where it's invested. So this graphic really shows you rough carbon footprints of various individual actions you might take. So it's what we're arguing is that everything on this list is very important to do, but there's a very large value in having your investments be invested cleanly. You can see why engaging with those who manage money on your behalf is really essential. So we won't spend a lot of time on this webinar talking about managing your own personal investment portfolio. I'm actually not a financial advisor, and I don't feel comfortable suggesting specific investment products. Those are all very unique to individual strategies. But I wanted to provide some high-level suggestions for those who have personal investments and how to approach shifting those investments. And really what we're talking about, unless you're doing all of the investing yourself, we're talking about having a conversation with your financial advisor, your bank, your credit union, whoever you sort of go to for help managing investments. And so quickly walk through a couple of sort of approaches that are important to consider. And first and foremost, in having a conversation with somebody who's managing your money, it's really important that we always start with transparency and to understand what's going on. So before we can start talking about changing how things are managed, we need to understand the current situation. Where are your investments today? And a lot of Canadians that I've spoken to aren't always entirely sure. A lot of investment products are not transparent and are a bit complicated. And a lot of sort of funds have a lot of things in them, and it's very hard to understand fully what you're invested in any given day. So if you're talking to your financial manager, or if you're in a bank and they're trying to sell you a product, you really need to ask, okay, where are you invested? And if you're invested in a mutual fund or an exchange-traded fund in Canada, there's a very strong likelihood that you have a significant exposure to fossil fuels in Canada. Canada's public equities market, the Toronto Stock Exchange, the TSX, is very overweight on fossil fuel companies. Energy companies total make up currently about 10 to 15% of the TSX. Oil and gas is less than 6% of the Canadian economy overall. So you can see that that's quite overweight. In the past, when fossil fuel companies were doing better, they've been very poor performers on the market in the last number of years. They made up as much as 1/3 of the TSX at their peak. which is huge given all of the other areas of the economy. Oil sands related companies, for example, they take up a lot of oxygen and air in the conversation, but oil sands as an industry directly represents less than 2% of the overall Canadian economy. So it's really important to understand that in Canada, everything is about fossil fuels much more than it should be relative to its importance. So if you're invested in funds of those kinds, you are almost certainly exposed to a large number of those companies in your investment portfolio, and that's key to understand. But you should be asking about that. Once we've sort of understood what's in your portfolio and sort of gotten over that first hurdle of having an open conversation about what you've got, I think, or if you're new and you're going in for the first time to meet with a new financial advisor, you want to explain your expectations for them. And that's something a lot of people aren't always able to do because they feel like they don't know enough. And they go to financial professionals for this sort of advice and expert guidance. But it's absolutely acceptable for you to come in and say, I have an expectation that I don't want any of my investments in fossil fuels, or I have an expectation that I want a certain percentage of my investments specifically invested in climate solutions. You may have other considerations about social concerns or other sort of areas where you do or don't want investments, and those are all legitimate as well. You can say, I don't want my investments in private prisons or in weapons manufacturers or in tobacco. You can say those sorts of things to your advisor, and they work for you. They should figure that out. And shifting your investments right now in Canada can be tricky. And I often use the analogy of trying to buy an electric car in Ontario right now. If you walk into the average car dealership right now in Ontario and tell them, I would like to buy an electric car, please, rather than trying to accommodate you, many dealers at the moment will try to talk you out of it. They'll say, they don't understand electric cars. They don't know how to sell them. They don't make nearly as much money repairing them because they have low maintenance. And they just want to sell you what they already have in the showroom and sell you stuff that they know about. So they'll try to talk you out of it. If you do end up persisting and saying, no, I really do just want an electric car, then they'll often inform you that they don't have a lot of options available. They don't have any inventory. If you can just get on this waiting list and get back to you. So they really make it difficult for you to get what you want, even though there are many products out there that exist, and absolutely, you should be able to get those. It's the same for investing, carbon-free investing in Canada right now. If you ask for carbon-free investing, they have those products, but they often will sort of try to talk you out of doing it. There's sort of a lag in the understanding of the financial industry about some of these subjects. So it's important to remember that you can ask for those things and you should stick to your guns, because oftentimes the first reaction you'll get will be, oh, I don't know anything about that, but that's not a good idea. So set up the expectation, tell them I don't want my savings invested in fossil fuels. I want some exposure to climate solutions, whatever it is that you're asking for. And then tell them it's up to you. I'd like to hear from you what your plan is. What can you do for me? And if they don't have a good answer, or they don't want to respect your expectations, there are many other financial planners or advisors or banks or credit unions out there who may have that they can offer. So you can take your business elsewhere. And that's really important to realize, that just because they're telling you that they can't do it doesn't mean that someone else can't. So there's really substantial power in asking questions of your advisor. And that's one of the things we're sort of hitting home here, is asking these questions and telling them what you want clearly and plainly is having big systemic impact. All over the country right now, financial advisors are frantically trying to learn about what carbon-free investing is. They're trying to understand the products better. They're trying to get their head around this because they're hearing these questions coming up more and more. And we've been talking to a lot of different financial planners in the last while, and they're saying they really are hearing this, and it's causing a change in the entire industry. So it's important to be part of that. And you should know that there are many high-quality carbon-free mutual funds, exchange-traded funds, index funds, green bonds. Those are all available products. There are lots of good companies to invest in, lots of places where you can invest without having a really negative impact. And so your financial planner should be able to direct you into those and set up a strategy for you. I wanted to quickly cover some terminology you're going to hear. It'll come up in our discussion around pensions as well, and Patrick jumps into the details there. But it's good to get your head around these early if you haven't already. ESG, you're going to hear that constantly. It is the buzzword in finance in 2020. It is all the rage right now, and it's sweeping the global financial sector. ESG means environmental, social, and governance factors. And as shocking as it sounds, it means for the first time ever, investors are expected to consider environmental, social, and governance factors in their investment decisions. There's no rules, no hard line definition for what that actually means in practice, but considering environmental, social, and governance factors is now finally being brought into investment decisions. So if you hear, oh yes, we have an ESG fund, it just means that somehow in the design of that fund or in the thinking, they're considering those factors. And considering can be pretty vague and not always meaningful. So there's no guarantees in an ESG fund or an ESG product that they're free of fossil fuels or bad companies. In fact, you'll often find ESG ratings can go to pretty terrible companies. And that's because ESG tends to favor leaders in each sector. So not the best companies out there total, but the best in the sector. So what's the least worst oil sands company when it comes to pollution? It's a good example. So you can get a very high rating within the other oil sands companies, but they're all incredibly large carbon footprint companies. So that's a warning around ESG. ESG funds are often currently dominated by big tech companies because they don't raise any of those major flags. So, FANG companies, the Facebook, Apple, Netflix, Google companies who have their own ethical issues to contend with. So just a little bit of a warning that ESG it's valuable that the sector more broadly is considering these important factors, but we sort of often need a better threshold than just considering if we're going to take this seriously. A second sort of term you might hear from an advisor is thematic investing, which can mean lots of things, but it generally means restricting your investment only to sectors that have meet certain criteria, so a theme. And you can do thematic investing around climate change by saying, I'd like to be thematically invested in clean energy, clean technology, clean water, clean infrastructure, sustainable agriculture, anything that fits a theme that you think is appropriate, and sort of a walled garden of investment opportunities that don't have a lot of harm and can have a positive benefit. But in the thematic investing sort of term, we're talking about companies that are still providing a market return. They're ordinary companies out there trying to make money, but they just happen to not be in dirty, polluting industry. Similarly, you'll hear carbon-free investing is a term that's picking up a lot of speed. I quite like this, and it generally means you've set an expectation to exclude. It's very similar. It's the sort of flip side, excluding high carbon companies who make money from extracting, refining, shipping fossil fuels, electrical utilities that burn coal or gas. Sort of the high carbon assets are excluded. And finally, probably it's really important to make a distinction that you'll hear impact investing. And when people hear ESG or carbon free, they're often thinking impact investing, but that has a very specific and unique definition. So it's important not to mix them up, as many financial advisors do. If you're saying I would like to make impact investments, it means generally that you're willing to accept possibly a lower rate of potential return in exchange for above and beyond positive impact for your investment. And there are lots of great and very good, healthy return investments out there that are technically impact investments, sustainable bonds, all sorts of things like that. But if you talk about, I'd like to get carbon out of my portfolio, you're financial advisor may very quickly jump to saying, oh, well, we don't want to leave money on the table. We don't want to do impact investing. They're often conflating these different pieces. So it's important to understand that impact investing is a different category. So those are sort of the high level notes, but recommend if you're serious about doing this, go and talk to whoever is advising you or helping you manage investments, and ask some tough questions and set your expectations, and do your own research if you're not happy, to find financial advisors who actually do have some expertise in tackling climate change in your own personal portfolio. We've often worked with an advisor in Toronto named Tim Nash, who has a business called goodinvesting.com. He offers advisory services, but there are many others like Tim out there. So, depending on which community you're in, it's worth looking to see who's out there. And there are more and more of them. It's becoming a rapidly growing area. And I think my colleague Patrick was pointing out, maybe we could talk about it a bit more. There's another group out there called As You Sow, and they actually track a lot of different ethical investments and low carbon investments, and sort of keep the database of that information. So those are some quick resources, but we can talk more about them others. So that's personal investing, and we can discuss more of that at the end. But we're going to move quickly now into talking about Shift's specialty, which is Canadian pensions. And we focus on Canadian pensions because individual investments are important and have systemic impact, but the world's largest asset owners and investors around the world are largely made up of very large funds that are often pension funds. And in Canada, we have some of the world's largest and most influential pension funds in the world. Canada Pension Plan, which is huge, is the 8th largest asset owner manager in the world, with over $400 billion in assets under management. The top 10, the ones that you see on the screen right now, have roughly $1.7 trillion Canadian in assets under management right now. So they're absolutely massive. They're invested all over the world. They have very substantial influence in all areas, all different industries. They're very sophisticated. And in particular, the Canadian pension fund model is actually was invented in Canada and is widely emulated in other countries now. So the Canadian model is essentially having a team of dedicated financial professionals with no direct link to your employer actively manage your investments. And they try to use a variety of very complicated and sophisticated tools and an international level focus to try to beat the market. And so that's sort of the Canadian model we're talking about. If you're a member of any one of these pension funds, and I will say all working Canadians, all Canadians who have contributed at least one paycheck when they're over the age of 18, is a member of at least one pension fund. You're going to be part of Canada Pension Plan, or if you're in Quebec, the Quebec Pension Plan, which is managed by the Caisse de Dépôt. So all of you can participate in engaging your pension fund, and it's an incredibly important way to change, the future, and to make sure we're actually going to address climate risk and to also protect investments. I think we can dive right in. I'll talk about quickly. So those are the big pension funds we're focused on. There are many other smaller ones, private ones in Canada as well, and we can help you engage with them. The strategy is going to be very similar. And we're going to focus in on a couple of the sort of key pension funds we know that there are lots of members of on the call. But it's important to recognize that a lot of these pensions have very similar strategies, very similar portfolios of investments. So there's a lot of applicability, even if it's not your specific pension we're talking about. We pulled this graph together back in 2019, assessing the management of climate risks and opportunities by Canada's largest 10 pension funds. And we were being very generous here. Canada's financial sector and our pension funds are way behind the international best practice. It's only in the last couple of years that these institutions have recognized that climate change poses a risk to their investments, and that they need to do something to manage that. And they've just started in the last couple of years rolling out tools which will help them to better understand that risk. But it's, we've ranked them from basically nowhere to pulling ahead on this list, but it's important to recognize that most of Canadian pension funds are still very far behind the best practice internationally. So some of the things that they're doing, that they sort of the first baby steps that pension funds can take on, is to recognize that climate change is a material risk to the value of their portfolios, putting in place governance structures to understand that risk, hiring analysts to investigate it, so they'll actually have some experts on staff. They look at different scenarios for where the future might go and test that against what their investments look like. They're carbon footprinting, so they're trying to figure out what the actual carbon footprint of their portfolio is. So those are all sort of the basic levels of understanding climate risk. But once they understand it, we've seen very few pension funds in Canada to date actively taking real steps to address those risks and to say we're going to actually commit to achieving the goals of the Paris Agreement to keep a safe climate and to aim for zero by mid-century for our emissions. And we've seen very few pensions actually say we're going to shift investments as we're talking about. So it's really important that we engage them. Right, so I think I'm going to kick it over to my colleague Patrick, who's a longtime climate expert who's been working on policy and around climate change at the provincial and federal level for a number of years, and he's got a lot of depth. And Patrick has also done a lot of deep dive research into the individual pension funds that we're talking about here. And actually, we've created a toolkit which has a lot of detail on each one of these. So if you're interested in more information, Patrick keeps those up to date, and we can send that to you. So I'll pass it over to you, Patrick. And we're going to dive into a couple of the sort of the big pension funds so you can get a sense of how they're managing climate, what they're doing and what they're not doing.
Yeah, thanks, Adam. Like Adam said, we've spent a lot of time in the last year compiling and scouring through every publicly available source of information about these funds. So that includes regulatory filings, third-party reports from NGOs or consultants, the annual reports, responsible investment reports of the pension funds themselves. So we have those in some toolkits, and I'm going to give a bit of a summary on 4 of those funds that we heard from you folks last week that you're a member of. So that includes CPP Investments, which all Canadians are members of, PSP Investments, that's the big federal public service pension plan, as well as OMERS, the Ontario Municipal Employees Retirement System, and the Ontario Teachers Pension Plan. So I'll start with CPP Investments because it's the largest in Canada, and also, like Adam said, one of the largest in the world. This is the national pension fund for over 20 million Canadians. They just put out their quarterly report last week, saying they have now over $450 billion in assets. So they're getting upward toward $500 billion. And just to put this in perspective, that's the size of like a country the size of Austria, Nigeria, or Iran. So it's not your typical RSP. It's absolutely huge. And they own large parts of the real economy. So infrastructure, utilities, global companies, healthcare companies, entire blocks of downtown real estate in Toronto or other global capitals, airports, toll roads. They're so big that they actually own this physical infrastructure. So just wanted to kind of get that across, the size of this funds. Next slide, please, Adam. Adam mentioned some of the tools that CPP Investments is using. They do carbon footprinting and scenario analysis, and they claim to have climate change embedded across their governance structure. And they've begun filing annual TCFD, the Task Force on Climate-Related Financial Disclosure reports. So they are doing the bare minimum, and we've actually seen some good progress on them investing in renewable energy and other climate solutions recently. So in 2019, they issued a €1 billion green bonds that allows companies to buy it and invest it in climate solutions. They bought one of North America's largest wind energy producers, Pattern Energy, for about $2.5 billion this year. And they now have about $6.6 billion invested in renewable energy. And if you go to the next slide there, Adam, that's just the growth that we've seen in CPP's renewables investment over the last few years. So this is a good thing, and it is a growing part of the portfolio, but it's not nearly enough. And we actually don't know how a lot of those internal processes and tools that they're using are actually influencing their investment decision-making. So yes, they do have a handle on climate risk management, but we don't actually know how it's telling them whether to invest or divest of a certain company or sector. On the next slide, Adam, we know from their filings that they have at least $12 billion invested in fossil fuel companies, which is nearly double their renewables holdings. This crosses the gamut of coal, oil sands, pipelines, and gas. They have a mandate to invest in the best interest of Canadians, but that doesn't seem to include tackling climate change. And they have been very adamant that they will not align their portfolio with either Canada's climate commitments under the Paris Agreement or the Paris Agreement goal of zero emissions itself. And we're seeing the negative effects of this. They reported in their 2020 annual reports that their energy and resources portfolio, which is largely fossil fuels, declined by 23.4% year over year. And that was the worst performing portfolio under CPP's management. So we're actually seeing these impacts in real time, accelerated by the COVID crisis. I'll give a few particular examples of CPP investments, poor investments. So for one thing, they have about $141 billion in Chinese coal companies. Why we have our national pension fund invested in Chinese coal is beyond me. These investments are completely out of step with the Paris commitments or the Paris agreements. And they've been quite intransigent about acknowledging a need to reduce their fossil fuel exposure. And I'll note that it's very difficult to amend the CPPIB Act, the legislation that oversees the mandates of this pension fund. It's basically the same as trying to amend Canada's constitution. So you need the federal government legislative change, but also 7 of 10 provinces and 2/3 of the population. So very difficult to change the CPP's legislative mandate. And that was designed to make it insulated from political risks and political differences. I'll do a couple of examples of some particularly risky investments. So one is Neffin Energy in Ireland. Essentially in 2017, the CPP bought a bunch of gas reserves off the coast of Ireland from Shell with the expectation that they would develop them. But the next year, the Irish government decided to ban offshore oil drilling. And then just this year, they decided to extend that ban to new offshore gas reserves. So even though CPP made this big investment in Neffin Energy and bought all these gas reserves, they're actually not allowed to grow them because they can't get new licenses from the Irish government. We think this is an example of CPP not properly assessing the transition risks that come with investing in oil and gas. Another example that maybe you saw in the media this fall was a company called Crestone Peak Resources. And this is a Denver-based fracking company that the CPP bought in 2016. So they outright own this fracking company. And it's been the subject of a lot of complaints. So people in Colorado were seeing worker injuries, a lot of complaints to Colorado's oil and gas regulator, strange and rare illnesses, breathing problems like asthma, poor air quality near these fracking sites. It was causing earthquakes. There was a few examples of explosions near people's homes, toxic fumes, people getting sick. So this was not a very well-liked company in Colorado. And CPP fund managers that oversaw this transaction to buy this company now sits on Crestone's board of directors and executive team. So they're actively engaged in the governance and operation of the company. It became really controversial in Colorado when they began trying to drill next to schools, playgrounds, and houses. So within a mile, in some cases, of schools, they were trying to drill fracking wells, and people were getting sick. When communities fought back and tried to push for a moratorium on new fracking wells, and also to put in place setbacks that are at least a mile and a half from these more controversial sites like houses and playgrounds, the company responded by pouring money into Colorado's 2018 state elections. So we saw Crestone Peak Resources, owned by the CPP, pour about $600,000 US to try and elect Republican and pro-oil and gas candidates and super PACs and interest groups to try and influence Colorado state elections. There's a big story in the Globe and Mail about this in September. Maybe we can share it in the chat after in the Q&A. But we see this as a really bad example of CPP's behavior with our pension savings. Like I said, next slide, please, Adam. We really don't think CPP has a good handle on climate risk, despite all the things they're doing internally. Based on some of these statements that I put in the slide, they don't seem to understand the nature of climate risk, that we actually need to reduce production in fossil fuels, that we actually need to align this portfolio with the Paris Agreement in order to maintain a safe climate. And they seem to have this misplaced faith in oil and gas companies to somehow change their core business model, which is, of course, extracting and refining and burning and transporting oil, gas, and coal. So we don't see them as having a good handle on the urgency of this crisis. And they seem to think that by investing in these companies, they're going to solve this problem. They've taken a pretty strong stand against divestments, but we do see some cracks in their armor. So you guys might remember a story in 2019 when it came out that the CPP was investing in the private prison companies like Geo Group and Core Civic that were detaining migrant children along the US-Mexico border. And there was public outrage, obviously, and within a couple of weeks, we saw CPP divest of those private prison companies very quietly. So as much as they say that they're not influenced by public opinion or by moral or ethical issues, this suggests that they actually are influenceable, and we kind of use it as an example as the changing reputational risk of certain sectors, such as fossil fuels. I'm going to pivot quickly to PSP Investments. This is the Federal Public Services Pension Fund, about $170 billion under management. It's the fourth largest in Canada. A few good things, credit where credit is due. They have about $5 billion in investments in renewable energy. They're using those range of tools across their portfolios to measure climate risk. They actually have reduced their carbon intensity of their portfolio over the last 5 years. And just in their annual report this year, they admitted that they decreased their oil and gas investments between 2019 and 2020, and that this was actually a tailwind in the wake of COVID, so that this actually buttressed their portfolio. It actually led to less losses because of their underexposure to fossil fuels this year. However, though, we really see poor disclosure and transparency from PSP Investments. We actually don't know a lot about what they're investing despite how much we've looked. They outright own, along with the Alberta Teachers Retirement Fund, AltaGas Canada, which was a $1.7 billion transaction in 2019. And this is a company that has gas distribution, extraction, transmission, and generation projects across Canada. We have some research from Corporate Knights that shows that 12 of their top 25 public equity holdings are oil, gas, coal, and pipeline companies. They just doubled their ownership share in a company called Petrogas Energy Corp. And they just partnered with other investors to buy a gas station chain in the UK. They're also a big operator and owner of airports, which obviously is a bit offside with climate commitments. And they, like the CPP, have no screens for fossil fuels. Quickly on the Ontario Teachers Pension Plan, this is the third largest in Canada, about $205 billion in assets under management. We would say that the teachers are probably furthest ahead than a lot of these funds in Canada on managing these risks and putting in place the tools to get a handle on them. They've shown that they've actually decreased their investments in recent years and have ramped up their investments in renewable solutions. Just last week, they announced a €750 million euro green bonds to invest in climate solutions. And if you go 2 slides ahead, Adam, they've actually shown that they've reduced their carbon footprint by 15% of their portfolio between 2019 and 20. One more slide, sorry, Adam.
There you go.
Yeah. So they're actually actively reducing the carbon intensity of their portfolio, and they say this came from one big asset sale. We can't figure out what it was, and they haven't disclosed it, but it does show that the majority of the emissions in their portfolio are coming from a small number of companies in the oil, gas, coal, and materials sector. On the other hand, though, again, they're not doing enough. We don't know how their climate risk management policies are actually affecting their investment decisions. They keep saying that their ownership of these oil and gas companies is leading them to improve their outcomes, but we don't know how, and there's no public disclosure of why. And there's no clear standard or metric for screening out companies who are bad actors. They've made allusions to excluding coal and oil sands companies, because those are high carbon. But we don't know why, and we have no evidence that they're actually doing that. So like the other funds, they're still invested, if you go to the next slide, Adam, in the big oil sands, oil and gas exploration, coal and pipeline companies. And just last year, they made a $10.1 billion investment, along with a consortium of the other institutional investors, in the Abu Dhabi National Oil Company's gas pipeline network. So as much as they say they have a handle on climate risk, they just very recently invested in a massive piece of fossil fuel infrastructure that's designed to operate for 30 or 40 years into the future. A couple slides ahead, Adam. The OTPP, the pension plan for the Ontario teachers, has actually put in place some divestment policies. So they exclude apartheid companies during South Africa in the 1980s. They signed tobacco-free finance pledge in 2018, so no investment in tobacco companies. And they exclude guns and arms manufacturers and cluster munitions, anti-personnel mines, and weapons of mass destruction. And they say this is because it needs to be in alignment with Canada's international obligations. To which we would respond, why does that not apply to the Paris Agreement? So a little bit of inconsistency there from the teachers on their divestments and exclusionary policies. And finally, I'll talk quickly about OMERS, the seventh largest fund in Canada for all Ontario's municipal employees. They also have some good climate risk management programs in place. They have about $3.3 billion invested in clean energy. Their real estate arm, Oxford Properties, has reduced their carbon intensity significantly. And they're using some of those tools that Adam mentioned to manage this risk. But again, we're estimating over $2 billion invested in fossil fuels. 7 of his top 15 equity holdings are oil, gas, and pipeline companies. They own a bunch of natural gas and fossil fuel export facilities in their private equity portfolio. And they also own partly a utility in Washington called Puget Sound Energy that is trying to use their lobbying influence to block a gas hookup ban that's proposed in Washington, and is also trying to build a coal export terminal right now in Tacoma, Washington. So we're seeing some inconsistencies there. I'm going through this pretty quickly, but we can talk more in the Q&A. OMERS, again, has a divestment screen for cluster munitions and weapons manufacturers. And they say that they have this set of criteria for why they exclude those companies. And we found this really interesting. They have a 3-step process that has 3 questions. Does the material cause grievous harm? Is there an international treaty aimed at eliminating this product? And no level of engagement with this company will create positive change. For example, when the product is the organization's core business. And to us, that would seem to apply to fossil fuels. Those 3 questions apply to oil, gas, and coal companies, but it somehow is slipped through OMER's exclusionary investment screen. And that's a bit of a puzzle for us in just pointing out those inconsistencies. So that's a really quick run through of 4 of the funds. We have a lot more information on this if people are interested, but I'm going to pass it back over to Adam because we're running a little bit out of time here and we want to talk about what you can do about it.
Thanks, Patrick. Yeah, it's my fault for spending a bit more time than I'd planned at the beginning talking about personal investments. So we've blown through our time a little bit in terms of Q&A. So I'll try to be very quick in wrapping up, but to talk about the tools and what you can do, and then we'll get some Q&A time in. And I'm happy to keep answering questions as long as we can after we get through them. So, but that was all really valuable and important information to sort of see what we're actually talking about when we're saying shifting investments. It's really critical to have a sense of what's in these portfolios that we all own. These are our wages that we've saved over lifetimes of work, and it's important that they're invested responsibly. So Shift, as our organization, really is here to provide resources and supports and education for Canadians to help them engage their pension fund. We're not super powerful as a small nonprofit project, but actual members of pension plans are, and they can ask tough questions and they can provide their feedback. And we are demonstrating that when pension fund beneficiaries or savers or members of these funds reach out and engage with the pension fund, it actually really does push them forward. And we're doing that with all of the funds that we talked about today. We're working with groups of engaged climate active Canadians who really care, and they're asking smart and constructive and tough questions to their pension funds, and they're getting responses. And that conversation is really having a big impact. So we've created toolkits for each of the pension funds, which sort of a how-to guide on how to engage effectively for those who really want to dive in deeper. We're doing a lot of workshops and webinars similar to the one we're on right now. And we've created some online action tools, which have been effective, especially now when personal meetings and those sorts of things are difficult. Digital actions work really well on our website. So if you go to shiftaction.ca, or you can go to shiftyourpension.ca, we have an action tool on our site which allows you to select which pension fund you're part of, and Canada Pension Plan's on there as well. And there's a letter on there already, and it'll send it on your behalf to your pension fund manager. And that letter includes specific questions that you would like answered. So they need to respond to you. It's not just a one-way conversation. You're asking them about how they're approaching climate risk. How are you managing my money? What are you doing about climate change? And they'll write back and provide answers. And once that letter has gone through, there's the opportunity to continue engaging. And that's something that Patrick and I are here to help folks do. We've had a number of pension fund beneficiaries request Zoom meetings or phone meetings to have a more in-depth conversation with their pension fund manager. Pension funds often have their own consultation workshops. They say, come ask us questions, make themselves available. And those are over Zoom at the moment. So you can join those and ask those questions there. They have annual general meetings where you can ask these questions. And as well, if you're retired, there are retiree workshops specifically for the pensions where you can engage as well that are quite effective. And as well, your union from your current or former employer is hugely influential with unions. They actually tend to sit on the governance structure of the pension funds. So you can talk to your union as well, and they can directly engage. We've also set up some high-profile letters from different beneficiary groups. Right now, we're running a letter specifically for Ontario teachers that is being signed by hundreds of teachers across the province from different school boards. We're going to publish that publicly, hopefully in a newspaper, and we're going to send the open letter to the leadership of the Ontario Teachers Pension Plan. So that's an example of the different activities. We can post a couple of these quickly in the chat. But I think I'm going to wrap really quickly so we have a few minutes for questions. I'm sorry for taking up more time than allotted, but we have so much detail here, obviously, to go through when it comes to talking about these large and complicated funds. So really do urge you, please do take the action, shiftyourpension.ca. And if you do that, then we'll be able to communicate with you further. So if there are opportunities for your specific pension that come up, we'll be able to let you know about them. And if you're an Ontario teacher, there's the action for Ontario teachers to get started as well. Great. So I can, why don't we go straight into, we can talk about AGMs and other stuff. Let's go straight into questions, because I think that's the sort of key piece. We still have a few minutes left here.
Okay. Thank you.
Sorry for taking so long.
Yeah. The questions, some of the questions are very specific and some are quite broad. So I'm going to start with the specific ones and then move to the general one. The first one is from, that I'd like you to address, is from Barry Mitchell. And he says, personal investment portfolios of seniors in banks, BCE, TELUS, etc., have increased in value, and selling them would create huge capital gains taxes. Any ideas?
Yeah, well, I mean, you don't necessarily need to sell out of companies that aren't sort of direct contributors. Banks are major financiers of fossil fuels. So as a shareholder, there may be a way to actually be active as a shareholder without selling. I think there are other ways of activism besides just selling out. If you have fossil fuel companies, that might be a different story. But I can't give you sort of capital gains tax advice. I don't think that's something I can do. But I think to say that if we're talking about companies like BCE or TELUS or those others, they're not sort of directly part of a strategy for either the problem or solution side of climate change. But the banks definitely, it would be important to think about shareholder strategy. So there almost always are shareholder resolutions that come up every year at the AGM, calling on them to adopt similar strategies that we've talked about here for pension funds with the bank. And you can also engage the bank the same way as a shareholder that we're talking about here with pension funds. Okay, new question.
Right. This is from Sherry Watson. She says, as seniors, protection of value of investments is important, and a frequent response from advisors is that the alternatives are too new and unstable for good investments. What would be your response?
My response would have been that might have been true 10 years ago. But if they're telling you that now, what they're actually telling you is that they don't understand what's happening in the market, because there are a lot more of those types of investments available. And over the last 10 years, we have data that shows that, depending on, the overall size of the clean energy market, for example, has grown exponentially, whether or not we're talking about clean energy or electric vehicles or batteries or utilities that invest in this. So all sorts of ways to gain exposure to clean energy that are much lower risk, much higher return potential. And these are stable, mature markets. So if they're saying that to you, that's a red flag that they're not maybe able to provide the kind of advice that you need.
So would you direct them to particular websites like As You Sow or others?
Yes, and I would also consider looking around in your own area, depending on where you are, for investment advisors that specialize in clean energy investing or responsible investing is probably the thing to look for. I don't have a link for a clearinghouse of that. That's something we're going to work on and see if we can find a way of providing a resource for where you can find those. But maybe we can help the Climate Legacy team with their new website when it's out to have some more resources there. So,
thanks. The next question is from Eva Berenger. She says, my congregation has divested its investment account from fossil fuels using the carbon tracker list. Is that sufficient to be considered carbon-free investing?
It's the biggest piece. It's where most of the carbon is. So it's a really excellent step. And I'm really glad to hear that that's happened. That has also, in addition to being much lower carbon anyway, it's had a big impact. There's the carbon-free investing can go much further. So there are other sectors that also have high carbon footprints that could be doing more. So you can be active as a shareholder in those areas. So that's sort of the next one. And you can also, and we advocate strongly to sort of set a higher goal for the percentage of your portfolio that you want to be actively investing in the solutions side. Because we need to not just be getting the capital out of the dirty stuff, the causes of the climate crisis, but actually moving more capital into areas where we're actually addressing the crisis. So I'd consider looking at further options for shifting into specifically clean energy.
Great. And Janet Marenica is asking what actions Canadians can take to assist Colorado in dealing with Crestone Peak.
Yeah, I think it's Lead Now. I don't know if Patrick, if you're able to share the Lead Now petition quickly enough.
Yeah, do that.
There's a group called Lead Now that was running an active petition, so you can actually sign that, and it'll send a letter to the Canada Pension Plan telling them to stop that investment. And it links in very much to the sort of language we've been sending to Canada Pension Plan as well. So that's sort of the direct action you can take, and I hope Patrick will share that.
Okay, and Roland Montpellier says he's with Omers and he'd like to use some of the slides on his blog site. So
yeah, we can do that, Roland. If you want to send us an email at info@shiftaction.ca, we can get in touch and we can talk further. How about that?
Great, thank you. And Letitia Charbonneau says, don't apologize. This was great. I have a meeting with my guy on Friday. Wish me luck.
I wish you all the best luck and stand your ground. And I'm really interested to hear how that goes.
Great. And Irvin says the chat was disabled, which is correct. So how can we get the links that were mentioned?
We can. This video is being recorded, so if there are links we're posting, they should show up again, and maybe we can offer to provide a list of the links to the hosts, and they can send it in a follow-up email if there is one.
The links have been shared in the chat. You can see we're able to post in chat. Attendees can't. Attendees can use the Q&A for posting any questions. Thanks, Curtis.
Here we go.
Okay. And Wendy, should we share this video on social media?
That would be great. And I didn't get a chance to plug our own social media channels, but you can find Shift on Facebook. You can find Shift on Twitter. You can find Shift on LinkedIn. We do have an Instagram account. I think we're using it somewhere. But if we're constantly posting new and updated information on a lot of what we talked about here today, and on ways that you can get active and involved. So if you follow us there, you'll be able to keep up on the latest.
Okay, we'll let you end with Lawrence's question, which is, given how unfriendly capitalism has historically been toward your type of strategy you're proposing, what gives you hope?
What gives me hope is that the world of finance has shifted on this just on its own in some ways, where clean energy and solutions to climate change are now cheaper and more effective and are actively undermining the business model of legacy fossil fuels in the market. So if you're running a natural gas power plant or a coal power plant, you're being outcompeted by lower cost renewable energy, for example. And there's examples on electric vehicles and many others. So finally, we're at a position where we can say it's not only the right thing to do, but it's also the profitable thing to do. What you'll find is that a lot of the market, a lot of people, advisors and people currently operating in the financial world haven't come to grips with that yet. And that's what they need to be pushed on. So there's a lag effect. But if you actually examine the data, you'll see it's now the right thing to do and the profitable thing.
Great. Well, thank you very much, Adam and Patrick. And we hope everyone found this presentation useful. And you can find it again to say on the Group of 78 site, and please do forward it to your friends and other people you think may be interested. Thank you very much, and we'll sign up.
Thanks, Ricky. Thanks, everyone.
Roy?
Yeah, I just wanted to thank both Patrick and Adam for a fantastic presentation. Patrick, I think you were about to say something.
I was just going to say thank you for having us.
Yeah.
Okay, so I just wanted to mention going forward that we have a partnership with Shift, and Climate Legacy is in the process of building its website. So hopefully we can work collaboratively towards bringing some of these resources together to help seniors and others as they contemplate shifting their personal and their collective pension assets, but also working in areas outside of the pension area, the retirement fund area, to talking about how to get the banks to shift and how to get insurance companies to shift. So there's a lot of work to be done, and I think we're making a very good start in that direction. So thank you so much, Adam and Patrick, and thank you for moderating, Ricky, and thank you from the back room to Sarah. And this should be up in a couple of days on our website.
Thank you.
Thanks, everyone.
Everyone.